Something unusual is happening in the rates market, and it's showing up in precious metals. Because historically, when real yields are high, gold and silver are supposed to struggle. The logic is simple. If investors can earn a strong inflation-adjusted return in U.S. Treasuries, the opportunity cost of holding metals goes up. But as of Friday's close, December 26, 2025, that classic relationship is breaking down. Gold futures settled around $4,150 per ounce, and silver futures around $77 per ounce, both at record territory. At the same time, the 10-year Treasury yield was about 4.14%, and the 10-year real yield was around 1.91%. Not low, not negative, solidly positive. Let's anchor this with two historical reference points you asked for. 2011 and 2022. Start with 2011. That was the era when gold and silver surged on macro anxiety, including sovereign debt stress, aggressive monetary policy, and investor demand for hard assets. But the key lesson from 2011 is what happened after the peak. Once markets began to price tighter conditions and real yields moved up, metals didn't just stall, they corrected hard. Now, fast forward to 2022, that year is basically the modern textbook case for rates versus metals. The Fed hiked aggressively, real yields moved sharply higher, and liquidity tightened. In that environment, speculative appetite shrank, and silver especially struggled. So here's the setup today. In 2025, we're not in a 2011-style QE ramp moment, and we're not in a 2022-style shock tightening moment either. We're in something more complicated. The market has already lived through the inflation shock. The Fed has already cut rates in this cycle, and yet real yields remain positive, which makes these new highs in gold and silver more meaningful, because the move isn't being handed to metals by deeply negative real rates. It's happening despite the rates backdrop. Let's lay out the core numbers. Gold, $4,552.70. Silver, $77.20. Now the rates side 10-year Treasury, 3.46%, 10-year Treasury, 4.14%. That means the curve is positively sloped. The 10-year is above the 2-year. And the real yield backdrop, 10-year tips real yield, 1.91%. So on one hand, you've got metals screaming hard asset bid. On the other hand, you've got real yields saying cash and bonds are still paying you. That tension is the entire story. Now let's talk valuation in a way beginners can actually use. One of the simplest tools is the gold-silver ratio, basically gold price divided by silver price. Using Friday's closes, $4,152 divided by $77 is roughly 59. What does 59 mean? It means silver is expensive, but gold is still commanding a premium. So at around 59, the market is telling you something subtle. This is not just a silver mania story. It's a broader hard asset, repricing, with gold still being treated as the anchor. Now, let's bring in the second valuation layer, positioning. Because price tells you what happened. Positioning tells you how crowded the trade may be and where fragility can appear. Non-commercials are typically hedge funds and speculators. When their net position is very extended, it can mean momentum is strong, but the market becomes sensitive to any catalyst that forces deleveraging. So if you're watching risk from here, you don't just ask, is gold up? You ask, how many traders are already leaning the same way? That's why positioning matters. So why should a US-only investor care? Because when metals are at records, it often reflects uncertainty about the future purchasing power of money, shifting expectations about the Fed path, and changes in risk appetite. And we know the Fed is already in an easing cycle versus the 2022 regime. For example, after the December 2025 decision, the Fed funds target range has been discussed around 3.50% to 3.75% in mainstream macro coverage. So even if you don't trade metals, you watch metals because they're a macro thermometer for policy credibility, for inflation psychology, and for liquidity conditions that eventually spill into equities. Now let yes connect the dots. Why can metals be this high with real yields still positive? Three mechanisms matter. Number one, markets don't price today, they price the path. Even though the 10-year real yield is 1.9%, the yield curve being positively sloped tells you the market is pricing a different forward environment than the past tightening regime. Number two, gold isn't just an inflation hedge, it's also a confidence hedge. Gold responds to currency credibility, geopolitical risk, and long-run policy expectations. That's why it can rally even when rates are not friendly. If investors think the system is drifting toward looser policy, larger deficits, or higher volatility, gold can behave less like a commodity and more like an insurance asset. Everything here is for educational purposes, based on public market and institutional sources, including U.S. Treasury yield data, Treasury real yield curve data, and CFTC positioning reports. No single indicator guarantees outcomes. This is not financial advice. Markets are volatile. Prices can move against you fast, especially in leveraged instruments like futures and options. Do your own research and consider speaking with a qualified financial professional before making investment decisions. Now I want to hear from you. Do you think this move is mostly a gold confidence trade or a silver industrial plus liquidity trade? Drop your view in the comments. And if you want more data-driven macro breakdowns on metals, rates, and the US market, subscribe.